If you look at infrastructure, it's really an asset class that we kind of look at 2011 is when it really started taking off. And since 2011, every 5 years, we've seen AUM double in infrastructure. At the end of 2023, after seeing about $15 billion in transaction volume for that year in infrastructure secondaries, dry powder was only $9 billion left. That meant that the ratio of dry powder overhang is pretty attractive. Renewables continue to be an area of interest, not just from a sustainability or a climate view, but a big part of it is also that we need this energy. We found that infrastructure pricing has been pretty consistent and have been on a level that is quite attractive for sellers, trading at mostly single-digit to low double-digit type of discounts.
Hi everyone, Happy New Year, and thank you for tuning in to another episode of Women of Secondaries, produced by SecLink and hosted by yours truly. My name is Kristina Kulikova. I'm the Senior VP of LP Advisory at Setter Capital, and I'm absolutely privileged to host Women of Secondaries, where we cast light on the incredible powerhouse women driving this market and their expert views on the secondaries industry. If you missed our prior episodes, make sure to check them all out on the Secondary Links video and podcast section, YouTube, Spotify, or catch short snippets of the discussions on Secondary Link's LinkedIn page. I could not be more thrilled for today's episode, since we'll be covering one of the most closely watched asset classes in the secondary market, which has experienced significant growth over the past decade, driven by increased investor demand, evolving market dynamics, and the asset class's appeal as a source of stable, long-term returns globally. And that is, of course, infrastructure. I'm excited to hear from our expert today about reasons for the attractiveness of the asset class, evolution in its appeal to both institutional investors as well as private wealth capital, and the impact and expansion of digital infrastructure as well as factors affecting its growth, such as ESG, geopolitical risks, and interest rate changes, and of course, what does the future hold for infrastructure secondaries in 2025 and beyond? And who better to speak to that than an incredibly tenured professional with over 25 years of experience encompassing secondaries and infrastructure, the current managing director and head of infrastructure secondaries at Macquarie Asset Management, Wandy Hoh. Welcome, Wandy.
Thank you, Kristina. It's a privilege to be here with you.
Oh, I'm so glad to have you for sure. Thank you for making the time. So Macquarie Asset Management is obviously a massive player in both the primary and secondary private markets across essentially all asset classes. From what I understand, 2,400 people operating in 24 markets globally. I think now, if I'm correct, over 900 billion in AUM, 200 billion of which is in infrastructure, invested from what I understand around 170 infrastructure portfolio companies. And to be at the helm of leading that charge or contributing to that charge must be both exciting and a big responsibility. But of course, I understand you've had a long career spanning various firms such as Glenfarne Group and Strategic Partners, etc. Can you maybe start by sharing some of that background and how you ended up in secondaries generally, what drew you in, etc.?
Yeah, of course. I'm just one of many that are contributing to this incredible achievement here that we have in Macquarie Asset Management. And it's really just exciting to be part of it all. When I think about what led me to where I am today, I can't say that it was by design or something that I said, oh, I woke up one day or maybe my lifelong ambition was to invest in secondaries. Quite frankly, I just fell into it. And it was probably one of the best things to have happened in my career. But lesson learned there from me was that despite all the planning that you might do, you just have to leave some room in life for things that may not happen according to your plans. So the quick story is about 25 years ago, I joined an incredible boutique investment bank by the name of DLJ. And then many things happened right after I joined, including a crisis in 2000 where the markets really went south. One of the first macro busts that we can remember, which also meant that there were all of a sudden a lot of the opportunities that were there disappeared. But then a new crop of opportunities arrived, including the chance for me to work on secondaries and invest in secondaries. Of course, at that time, no one knew what secondaries was, including myself, and it was a big learning curve. But I was very lucky to work with a team of really talented individuals and be part of a team. I was a founding member of this team to build a business that is an incredible business today and an incredible product on market. So again, I think what I take away with that is that life, it can take different turns, and I'm happy that the turn it took for me ended up where it is today.
It's funny that you say that, because I think most people who have sort of fallen into secondaries by chance say that it's the best thing that's happened in their career. And it just speaks to the amazing nature of the industry and its growth and the potential that you have to grow in the industry, right? Which is phenomenal.
Yeah.
And so if you were to describe the current state of the infrastructure secondary market, but here's the kicker, you can only use 3 words. What would they be?
I would say it's growing, it's sophisticated, and exciting. Those are the 3 words that I would pick.
Excellent. We'll put that on the tagline. So even judging from secondary market volume reports, Sutter published, there's a couple of other agent reports throughout the years, but infrastructure secondary transaction volume, from what we've seen, has continued to grow from, I think, just under 5 billion in 2020. And I think we're all excited to see that. But could you perhaps set the stage and kind of give us an overview of the infrastructure secondary market in 2024? Maybe some of the macroeconomic trends that were driving the activity, focusing, well, I guess both US as well as globally.
Yeah, certainly. I think you pointed out some key dates, including 2000 is when I started my career in secondaries. And when we think about the time frame in which it went from just under 5 billion, and I think the last stat I saw, of course, we don't have 2024 yet, but it's shaping out to another fantastic year. We're exceeding or close to 150 with some sort of number like that. If you look at the CAGR of that, it's simply astounding. But the thing is, you really can't have a robust growing secondaries market without a robust growing primary market. And if we kind of follow what happened with private equity, it explains a lot, right? Especially in the 20 years that have passed, we've had less public companies, but more private companies. And this really marks the evolution of the private market investing that has happened. When I look at infrastructure, it's a similar take. If you look at infrastructure, it's really an asset class that we kind of look at 2011 is when it really started taking off. And since 2011, every 5 years, we've seen AUM double in infrastructure. And when we look at what is in store for the growth in the future, and we kind of take a look at some of the numbers, we can see that in a very short time, over the next few years, we think the infrastructure market will exceed $2 trillion. And we couple it with what we're seeing in the secondaries market. The other stat that's astounding is that PE secondaries today sit at almost 8% of the overall AUM in private equity, whereas infrastructure secondary sits still today below 2%. So when we look at the potential growth, it makes a lot of sense. This is what makes us excited. And then finally, when we look at 2024 and the couple of years that have passed since, so if I kind of start ticking at a 2021, 2022, 23, and then now 24, volume has grown tremendously. But the one thing that's really in particular that was intriguing to us is that at the end of 2023, after seeing about $15 billion in transaction volume for that year in infrastructure secondaries, dry powder was only $9 billion left. That meant that the ratio of dry powder overhang is pretty attractive. And that also means that simply investors are still in a place where they need to catch up to allocate to infrastructure secondaries. And the supply is quite much larger than what we are able to absorb right now with our dry powder.
Yeah, and that leaves so much room for growth, right? So I think 2025 is going to see the effect of that, hopefully, as we look at 2025 stats near the end. So I understand that the infrastructure secondaries mandate at Macquarie Asset Management spans sort of various sectors, whether it's energy, utilities, transportation, digital infra, waste management, social infra, and maybe the list goes on. Holistically speaking, are there particular types of infrastructure assets, whether, again, renewables, transport, et cetera, that are higher in demand for LPs or secondary funds when they're looking at acquiring? And maybe we can make that same parallel for GP deals?
Yeah, I think generally, whether it's secondaries, primaries, investors, everyone is very interested in the whole data center and the digital boom, right? And that's accompanied by AI. We are certainly seeing that demand reflected in transaction related to secondaries, whether it is a GP-like continuation fund or LP interests that have more data centers in them and what happens with how they're traded and the pricing. I think that's all very natural. I think, when we look at it, we're very excited about the sector. We're very excited about the growth. But obviously, not all data centers are made the same, and this is when our underlying work really comes into play. So therefore, I think, it's one of these things where sectors are very exciting, the macro trends are exciting, but at the same time, you still have to do your work, and that whole sector will evolve, right? But we're still buying, we're buyers, and we're excited about the prospects. Renewables continue to be an area of interest, as I'm sure you have heard. Many infrastructure investors continue to be very interested in the energy transition theme. It is certainly not just from a sustainability or a climate view. That's one part of it. But a big part of it is also that we need this energy, which ties right back to the AI boom and why we're so excited about data center. What powers those at the end of the day? It's going to be energy. So that's another sector that we're watching closely and following closely. And there are other things that make us very excited. There are certain pockets in transportation that continues to be something that we're excited about. And logistics are also areas that we're excited and how that ties into infrastructure as well. So all in all, I think generally on the overall scale, as we think about subsectors and the entire sector of infrastructure, it is an exciting time to be investing in infrastructure.
Are there any, maybe I'll flip the question as well, because are there any sectors on which you think the sun has sort of set in infrastructure?
I don't think there is a sun setting, but I do think that, when we think about, the carbon footprint and infrastructure related to that carbon footprint, the sun has been setting for quite some time, right? Coal, for example, was something that people used to do that has been out of investors' area of where they can even touch for many, many years. You'll continue to see the trend evolving around that. But at the same time, we are looking at an environment where we do need a lot of energy. And I think that the focus is going to be on how do we make energy as clean as possible while using and needing a lot of it. So that might be one thing that I'm thinking about. But at the end of the day, there's one thing that's quite unique about infrastructure, right? It is essential services. It is things that we need. There are things that we really today can't live without. And for the most part, that has stayed pretty intact in the past few decades.
And I guess it's applicable to everybody, whether it's businesses, whether it's consumers, right? It's pretty much throughout the whole ecosystem.
Yeah. So I think there's going to be a lot more years and decades ahead of us where some of the same themes may still sit, but at the same time, of course, they'll evolve accordingly.
And so in relation to that, how would you say secondary market pricing differs in the various sectors, maybe for both LP deals and GP-led deals? Of course, you mentioned some of the sectors that are less in favor versus, something like data centers. But can you briefly comment on how do you guys look at pricing for just the various subsectors?
I think it's less about sectors when it comes to an LP transaction. Maybe that has some undercurrents in it, but at the end of the day, it's really about how good of a secondary are you buying. The one thing I will say is that most people will generally agree that we have found that infrastructure pricing has been pretty consistent and have been on a level that is quite attractive for sellers, right? Trading at mostly single digit to low double digit type of discounts. And that's really because of the fundamentals of infrastructure versus particularly whether one sector is in favor or not. There are some, obviously, how you manage a company, how you operate a company will all come into the valuation and factors into the performance of a fund and the performance of a company. But at the end of the day, you've got some really great tailwinds when it comes to infrastructure and for protection, right? They're meant to be giving an investor inflation protection. They're meant to have resilient cash flows, contractual cash flows. They're meant to be essential services that have high barriers to entry. So when we think about infrastructure, we're checking those boxes, right? Are they checking those boxes? And if they are, then generally, I think you're looking at a good asset. What can really harm an asset is leverage. if you over-lever an asset. What can really harm an asset is how you operate it, right? And we've seen some examples of that in recent years and recent times on how an infrastructure asset can also be mismanaged. So I think overall, I really don't want to say it's a sector. This is not a sector other than some macro themes we already discussed, but it's much more about how the assets are performing, what the GPs have done in managing those assets, and what the likely outcome are going to be around those assets.
Yeah, and to your point, I think obviously there's a lot of new entrants into the secondary market that are looking to buy an infrastructure, and digital infrastructure, sort of the next hot thing. But from what I'm hearing from you is obviously you still have to study the fundamentals very carefully and not just jump on sort of the bandwagon, right, of the next sort of viable trend, but still a trend. And so tied into that, how are you noticing factors such as inflation? You were just mentioning that, interest rates, global energy transition, you mentioned that briefly as well, but how is that impacting pricing and particularly the attractiveness of infra secondaries when somebody's underwriting it from a secondary perspective?
Yeah, I think generally it is because of the assets class resilience and the asset class ability to not be as prone to sensitivities around the performance with inflation and interest rates that have really kept pricing in a place in a level where you can transact. I think often people think about, the pricing is high. You're not going to be able to buy any good deals. Actually, the pricing, to me, you have to have a seller willing to sell and a buyer willing to buy. If you're going to pay a very low price that's not acceptable to the seller, at the end of the day, you don't have a transaction. So the way I look at infrastructure secondaries is poise and where is trading for transacting, which makes the secondaries market very attractive in the infrastructure area. And what makes us feel good about infrastructure secondaries as a buyer is the same very characteristics that we just talked about, right? Our investors and infrastructure investors are looking for that inflation protection. They are looking for that interest rate hedge. So at the end of the day, when we think about buying infrastructure secondaries and how pricing is affected by these factors, it is a similar thesis, is that it allows the asset class to stay at a pricing level where you can actually transact.
Yeah, that makes sense. And I think particularly, if you look at real estate, for example, secondaries, which so closely tracks what's happening in the interest rate environment, right? And then you want to have that counterbalance with maybe a longer duration sort of vehicle that in infrastructure that helps counterbalance the immediate impact of that.
Absolutely.
And maybe a little bit off script, but in terms of a seller, for example, if they're contemplating selling an infrastructure portfolio to you, right, as a buyer, or they're contemplating a NAV loan on their portfolio, obviously they're very different motivations, but have you noticed that the rise of NAV loans applicable or feasible to be done on infrastructure portfolios has affected the deal flow that you're seeing from a pure sort of sell side?
I think that if I think about where NAV loans have truly maybe made some of a difference is really on the GP side of the equation and less on the LP side of the equation. LPs that we've seen that are selling, it's not really because they're looking for distributions, and that's really what NAV loans have done, is to offer distributions. A lot of them are actually facing regulatory capital changes. They're facing just balancing portfolio, which a NAV loan is not really going to change overnight. The other thing I will say is that most LPs are very they're very conservative on leverage, right? They do think that it is a risk that they're not quite willing to put on their portfolios. So in considering a NAV loan versus a portfolio sale, for whatever needs that they might have, I'm still seeing portfolio sale to come out ahead of that. Okay. On the flip side, though, on the GP side of it, I will note that what we noticed in 2024 is that there were less GP-leds and more LP-leds. Some of that is driven by just overall what the market was heading to, from LPs needing to manage their portfolios and balance their portfolios. But some of that is also GPs exploring new ways to provide capital back to their LP versus doing a continuation vehicle. So I think that's one sector where you could have seen, I think our suspicion is less activity was a result of possibly NAV loans versus selling an asset into a continuation vehicle.
That's interesting to know. I think for sure the GP-led market has so much more room to grow in the infrastructure space, right? Would you say the reason maybe we're seeing less GP-led deals is also because just a longer term strategy versus, something like a PE fund, which may be more needing to faster return capital than maybe an infrastructure strategy, or no?
No, I think generally why we're seeing a little bit of a break is because we saw so much GP-led activities in the years before that, right? And I think certainly there were a great amount of transactions with really amazing assets. I hate to say the word trophy assets, but great assets that have been put into continuation vehicles already, right? It is unlikely that you could do that every year as a GP. So I think this is just a little bit of a slowdown because there has been so much activity, and not a indication that the market itself is not growing anymore or stopping, but rather everything that happens a lot needs a little breather. And this is a marathon and not a sprint. So I do think that it's going to pick up again.
Awesome. No, thank you. And so if we turn our attention to capitalization for the industry, obviously there was a bit of a challenging fundraising environment over the last few years. What would you say is the biggest source of capitalization for infrasecondaries? And maybe a little bit on what do you expect the private wealth and sort of family office side of the equation to drive secondaries?
Yeah, absolutely. I think for the most part, we're still seeing mostly institutional money that's really capitalizing the infrastructure secondaries market. But that is changing rapidly. We're seeing more and more interest from the family office side, but certainly also we're seeing more interest from the private wealth side as we have all seen more of these different types of 40 Acts private wealth type of vehicles have come to the market that is focused specifically on infrastructure. I think that's all a movement that's going to continue to happen. There are the dynamics of infrastructure secondaries that just makes it very attractive for private wealth and individual investors and family offices, simply because of the shorter duration, mitigating the J curve, and a diversified portfolio. All of those things check the boxes for those types of investors. And also then what has happened in recent years is the desire for their portfolio to include infrastructure, which is something that on the private wealth and family office side has not been a consideration in the past. So all of that is pointing to a really positive trend for infrastructure secondaries, where the investor base is really expanding, and we're very excited about that.
For sure. I think we've seen it on the PE side, just the increase in the 40 Act funds. And I think infrastructure is starting to also follow suit. And when we speak to family offices or also high net worths, the attractiveness of the 40 Acts also is that there is partial liquidity to them, right? So even if they're committing to a much longer term asset class, they know they're going to have these windows where they could at least generate partial liquidity if needed. So
absolutely.
Well, I'd love to hear your perspective on the future outlook for infrasecondaries in 2025 and beyond, perhaps covering geographic market expansion, the digital infrastructure we spoke about, it may be innovative deal structures, starting with maybe geographic expansion and sort of emerging markets, whether it's branching out into those markets as well.
Look, I think the secondaries is always going to be an adjacent product of the primary market. For us to branch out into the emerging markets, we got to see the primary market branching out to the emerging markets. I think we're starting to see that happen with a lot of managers now really focusing on either South America or Asia Pac, right? Here at Macquarie, we ourselves really focus on a regional approach. So we have always been in Asia Pac for a long time. So certainly I think, I don't want to say it's 2025 because again, it takes a few years for secondaries to be invested where the primaries have invested. But I think as we look out from 2025 onward, that will become a bigger piece of the pie.
And do you think that will disperse competition, or you think competition will still remain in the sort of the core markets like US, Europe, ODC?
No, I think that you're going to start to see there are going to be people that maybe specialize in particular markets that are going to start to chase after some of those because they are really truly experts in those markets. I think you'll see more of the larger players then also start to buy more of those because they are in the market for sale and they're starting to understand them more. I think generally is overall you're going to see more every player participating more in those markets.
I think when we looked at the 2023 volume report for Setter last year, or first half of 2024, that's what it was, and we asked whether everybody's looking to expand their diversification and strategies or sort of keep to the same that they've been investing. And I think it was almost like an 80% or something that was expanding into new strategies and new environments and geographies, etc. So yeah, it's interesting. Do you think there'll ever be a point where infrastructure secondaries sort of match or overcome that of PE or real estate or private credit secondaries?
That's a great question. I think it's pretty hard to surpass where PE is. It just is still, private equity is still the single largest alternative asset product that we have today. And I don't think that standing is not going to go away. Are we going to maybe close the gap more? I do think that will happen. If I listen to investors and what they're saying, generally what we're hearing is that their infrastructure allocations are going up and increasing. And while I don't think they're saying they're decreasing, private equity is holding steady. But there's still a long, long way before that increase is going to catch up to a full bucket in what they're allocated to private equity. So do we inch closer? We do inch closer. Do we actually outrun them anytime soon? Absolutely not.
And I've heard from a lot of like major LPs too that sometimes even if they're nearing their target allocation for infra, oftentimes their boards are actually, to your point, increasing that target allocation because they like the performance of the asset class, and it goes hand in hand.
Yeah, absolutely.
Yeah. And what are some of because secondary market continues to evolve, right? And we see this all the time, whether it's creative deal structures or the way you're actually paying for the deal or whatnot. What are some of the structures that you've seen in for secondaries that you were a little bit surprised about, or maybe the prominence of, let's say, staple deals, deferred deals, things like that you can speak to?
Those structures are more used in infrastructure versus PE or maybe real estate. But I think what we're seeing in terms of structure, things that have been more widely used in recent years, such as like deferreds or leverage and things like that, it's less about infrastructure, but more overall industry theme within secondaries. If you ask me, do I see anything that's more creative in infrastructure versus other asset classes? I must say not right now, but who knows? We might come up with something really quite interesting because we do have that unique aspect, similar to real estate, where we're generating cash flow throughout the portfolio even before we actually sell the asset. That's unlike PE, but it is certainly the structuring of how to acquire an asset today hasn't changed and is not different from where we are in PE.
Yeah, because a lot of preferred equity deals, for example, we'll see on PE, right? Or even earnouts on a major substantial part of a fund in PE. We've noticed that that's becoming a lot more commonplace in PE, but you're right, most of the time we'll see it in like venture where there's really an arbitrary outcome for a company, right? And somebody might say, well, we want to put some type of hedge on it where we then make an earnout for that company.
Yeah.
And
I think structures, like you said, you're hitting it right on the point, Kristina, is that structures really tie to the asset class itself, right? You're going to see preferred structures, like you said, match with more VC type fund. And I think in infrastructure, because you're seeing a stream of cash flows, right? Does a preferred structure really work? It might sound more attractive to an investor, but at the end of the day, is that really their goal?
Right. And I guess to your point, it's more predictable cash flow. Yeah. And to an extent return. Awesome. Well, Wendy, thank you for sharing your incredible knowledge and experience with us so far, spreading the excitement about the largely impactful part of private markets arena. This part of our chat, I really like to call the sort of bragging rights corner, where I would love to learn about any personal accomplishments you'd be interested in sharing, whether work-related or otherwise.
Okay. I think when I think about my proudest accomplishment is really the fact that I have raised 3 beautiful daughters at the same time while I've been, progressing on my career as well. So having both, I am really lucky, but I'm also very proud of that.
That's incredible. I'm juggling 1 4-year-old and I'm having a hard time.
It's very rewarding, I will say.
And I'm sure they look up to you and they're like, okay, if my mom can do this, I can do this too, right? And balance sort of career and work.
I'm just enjoy their company, and it's nice to be able to talk to them now that they're much older about work and sharing where they understand. So it's really nice.
That's amazing. Thank you for sharing that. And if we take it more to sort of a market question now, if you're speaking to a seller, and obviously you do this on a day-to-day basis, as you're looking to buy their portfolio, but if you roll it back to the point where they're making the decision or they're considering, should we proceed with a sale? Should we not? How should we look about our sale? What are maybe some of the considerations that they should take into account before they come to market? Or what are some of the areas that they should look out for or be prepared to expect when they come to the market?
Yeah, I think it's really important for the sellers to know what their goals are in approaching the market to sell their portfolio. It is, while, it's incredibly amazing how quickly transactions can happen, but it does take a lot of resources and time from the seller. right? And say for most part, most sellers, their day job is not to sell their portfolio. So therefore, I'd say really look at your goals. What are you trying to achieve, right? If you're really looking to raise cash and you want to sell down some of your assets, then you really should have that goal in mind to maximize your cash proceeds. And if that's the case, then you really need to look at what are the best assets to sell in that particular situation. That's an example. If your goal is to trim your overall portfolio, then you should really look at who you want to keep, who you don't want to keep, or maybe is it just a sale of your entire strip of your portfolio and one little strip, and making decisions along those guidelines before you approach the market. And not because you can't figure that out later. It's just that when you actually go to the market, you're going to attract different groups of sellers based on your needs, right? Based on what your goals are. And also, it saves you a lot of time and effort when you know going in what your expectations should be. And if I don't reach that goal, I go to plan B. Or if I do reach that goal, then I am done. And having that process in place and having that review prior to coming to the market, I think is just a really healthy exercise for all sellers.
Yeah, because being on the agent side, we'll often have sellers asking, okay, should we go to market and just expose our whole portfolio and open it up for sort of cherry picking? Or should we do the work on our end in advance and sort of see what are possible combinations? Because I guess their fear is sometimes a buyer may pick our cherry assets and we're left with something that we can't later sell. How would you answer that question?
I would say that just remember that at the end of the day, beauty is in the eye of the beholder. So while, sure, there are some obvious differences between your winners and your losers, there are other things that go into consideration when a buyer is buying something on whether that asset is a good asset or not a good asset. Meaning the cherry picking part is not just simply is something that everybody wants to own. A good example is that you could be up to your allocation as an investor on the secondary side on a particular manager or fund. So even if you love that manager and fund, you can't buy anymore. And just because we don't buy that doesn't mean that is not a good asset, right? It just doesn't fit in our portfolio anymore. And that same consideration can go for manager, vintage year, sector, and a whole host of different things when it comes to portfolio construction. So therefore, I think there's a little bit, this is why I say it's important on what goals you want to achieve, right? You should be ready to part with what you're ready to sell, and not just to say how is the market viewing this, because the market, again, beauty is in the eye of the beholder. Each buyer have different situations on the amount of capital they can deploy and what their current mandate might be, or things that is really what they're trying to fill their portfolio with. And trying to solve all that, you really won't have a straight answer because no one is disclosing that at the end of the day.
Yeah, exactly. And sometimes if sellers are especially considering sort of pragmatic sales, whether it's every year or every 2 years, I think it serves them best to sort of be prepared with those goals when they go to market versus having sort of a broader lens sometimes. This is a side question that we've seen come up more last year, at the end of last year, where groups have started to ask about some of the periphery services in secondaries, such as like insurance on transactions or insurance on secondary transactions, whether it be withholding tax implications or insurance against clawbacks, or and I know it's a little bit more relevant on the GP side when they're doing a continuation vehicle, but we've seen it proliferate into the LP side of the equation as well. Have you seen that applicable to infrastructure secondaries?
Oh, I think that overall the secondaries market are all learning about these products and what they can offer in terms of protection for the buyer, right? So I think it's not different for infrastructure secondaries. We're seeing those as well. It really, these products are in their own process of evolving. So I do think over time they'll have a place in all that we do, but it's still going through that product evolution period.
Yeah, interesting. So now, just before we let you get on with your day job, would love to ask you a few rapid fire questions to wrap up today.
Okay.
Ready?
Yep.
All right. What's the first thing you do when you get to the office?
Check my emails.
And then you can beg down a rabbit hole. And if you weren't in finance, what would you be doing?
I would probably, there are two things. One that's more related to finance would be probably consulting. But then one that's really completely off the beaten path is that I would own a restaurant.
A restaurant. Interesting. What type of cuisine?
Probably something Asian themed, but I do really enjoy cooking and entertaining.
I hear that's one of the toughest industries is the restaurant industry.
Yeah. It's definitely a vanity project versus a real life job.
Yeah. Well, who knows? Maybe we'll see you in parallel opening up a Wandy Hoh restaurant.
Yeah, it really wouldn't be something I could handle on a day-to-day basis. So I really admire all the restaurateurs out there. But But like you said, it's a dream. So here we go.
And what's the biggest lesson you've learned in your career to date?
It's okay to fail. Failure is good. You learn a lot from your mistakes and embrace those.
What if you get criticized for their failures?
I think probably if you think about where the criticism is the heaviest is your own self-criticism of your failures. And I think being able to learn from that and be able to walk away from that after doing the self-criticism is important. And then ask yourself, well, what have I learned?
Yeah, your lens is usually the one that's zooming in the most. And what's one thing your colleagues would be surprised to learn about you outside of the restaurant dream?
I do really, enjoy my time at home, just being in my very comfortable clothes and not going anywhere, because I think people think that I would want to venture out, but I become a homebody very quickly.
I think that's what helps you probably preserve the energy at work to be able to be your best, right? Is you need to recharge.
Yeah.
Yeah. Well, thank you so much, Wandy, for speaking with me today on the inner workings of the infrastructure market, which we might see expand past 30 billion by 2030. Who knows in terms of at least secondary volume? I mean, it's all the innovation is going to drive it there. And, I can't wait to see the waves you'll continue to make and driving Macquarie Asset Management forward and to new heights. And once again, everyone, this has been Wandy Hoh, and thanks for joining us today.
Thank you, Kristina. It's a pleasure to be on. Thank you.
And as always, watch the Secondary Link LinkedIn page for updates on our next special guest. And we hope to see you in a few weeks where we highlight the next incredible woman on the Women of Secondaries.